Willkommen, bienvenue, welcome, hello. My name is Gavin. I am a student at Lindenwood University, and this, dun dun dun, is my final presentation for investments. This presentation is going to be going over the U.S. economic outlook for the next few years, and is also going to be going over my personal risk profile and my views on market efficiency, so as to better explain where and why I would invest $100,000 into the market if that's what I chose to do. So let's go ahead and get started by looking at the U.S. economic outlook over the next few years. Some of the key indicators that you want to look at are the gross domestic product growth rate, or GDP growth, and currently that is at 2.2%. Now, the typical range that we want, the Goldilocks range for the growth rate, is between 2 and 3%. Right now, we're right where we want to be, and it is expected to stay that way until 2021, where it is expected to drop to 1.9%. So over the next few years, GDP growth is right in that Goldilocks range. It's where we want it to be. Another indicator of economic health is the unemployment rate. Currently, the average unemployment rate for 2019 and 2020 is supposed to be about 3.7% and may bump up to go to 3.8 by 2021. The federal target rate for unemployment is 6.7%, so right now we are sitting pretty. Another key indicator for economic health is inflation. Inflation is supposed to go to about 2% by 2021. Right now it's 1.5%, so 0.5% in 3 years is a little bit of a growth. However, if and when it gets to that 2% rate, the federal government may decide to lower interest rates in order to help combat that inflation rate. So overall, the economic outlook for 2019 and the next few years is healthy. We're looking good, and it's a pretty good time to look into investing. So when you're investing, what are some things that you need to know? Well, one of the most important bits of information that you need to find out about yourself is what you believe. And when I say that, I mean your risk and your market efficiency belief. So when finding out what your risk level is, it can be useful to find a risk tolerance assessment. Now, the University of Missouri has an investment risk tolerance assessment on its website, and I will put the link to this in the description of the video. I took this assessment, and my grade was a 26. On their scale, a 26 is right in the middle, average risk for average returns. I believe this is accurate for myself, and I thought it was very interesting to actually see this recorded quantitatively, and I recommend taking the exam, the assessment. Now, market efficiency is essentially asking how much does a stock price reflect the amount of available relevant information. Now, there are 3 forms of market efficiency: weak, semi-strong, and strong form. Weak form of market efficiency is essentially saying that every past bit of information is not relevant or used in current pricing. So this is actually a fairly popular form of market efficiency, as it says that investors, if they can use momentum rules or technical analysis, there are various forms of techniques in which a trader can predict where the market will go and can use that to gain above average returns. I don't personally believe this is true. I prefer the semi-strong form of market efficiency. The semi-strong form says that all public information is reflected in the stock quickly. There isn't much time for an investor to gain an edge. So, now I want to say this again, all public information. The only way for an investor to really gain that above average returns is to use insider trading, which is not legal. So, yeah. Now, the last form of market efficiency is the least popular. It's the strong form of market efficiency. The strong form of market efficiency says that all information, both public and private, is reflected by the stock, meaning there is zero chance to gain any sort of above average returns. So the only way that a strong form investor is going to invest is long term. Like I said, I prefer my medium to long term, semi-strong, average risk, average return investing. So, knowing and armed with this information now, let's go ahead and dive into the question. I've got $100,000. Now what? What do I do with it? Well, let's find out. So when trying to invest $100,000, you need to figure out what it is exactly that you want from that. Setting your goals. My objectives for this exercise, I want to take $100,000 of original investment, turn it into $125,000 over a period of 10 years. So my total return on investment is going to be about 25%, which means I need about 2.26% return on my investment each year. 2.26% is my magic number. None of my yields on my investments can drop below 2.26%, or else I'm not going to meet that 25% goal. So now you have to figure out, okay, you know your risk, you know what you believe, so whether you're going to go short term or long term, high risk, low risk, and whether, you know, what you want from it, what you want from your original investment. So where are you going to put it? You can put it in short-term stocks, short-term funds, or you can put it more medium long-term in bonds and long-term funds. I believe that the long-term is the way to go, as I've stated, and I will put most of my original investment into these long-term funds, which I will go into later. Now, something I do want to talk about when it comes to alternative options is real estate. I'm a California native myself, and I've constantly heard friends, family, acquaintances, even strangers talking about how they want to leave California due to high cost of living. Now, as a potential investment opportunity, this could be very profitable. Places like Idaho have seen housing prices rise drastically due to a large influx of California residents who are moving to the state to avoid that high cost of living and high housing costs. Now, I wouldn't recommend Idaho anymore because the prices have already raised, but another location that seems to be worth looking into would be Texas, for example. Now, $100,000 isn't going to go very far in real estate, so this is as far as I'm going to touch on it. I just thought it'd be worth looking into and worth researching more on your own. Now, a couple industries that I do want to bring up that could be very profitable over the next 10 years for my investments, healthcare and trucking, and they're both fairly for the same reason. Technology is advancing at incredible rates, and there's no telling what's going to happen in the next few years. In healthcare industry, we've already seen AI, artificial intelligence, being used to diagnose patients, and new treatments, new technology, and new pharmaceutical medications are all being released yearly, meaning that the healthcare industry could be very ripe to boom, and we can make profits. Another industry that I believe will be profitable in the next few years is going to be the trucking or shipping. Again, because of these increases in technology. One in particular that I want to talk about is RFID tagging freight or radio frequency identification tagging. Currently, most freight companies are sticking to the barcode scanning, which, while fairly accurate, still isn't as efficient as it could be. If a company were to implement RFID tagging into its freight, it would see a massive growth in efficiency and preventing lost or even stolen freight from occurring, as the RFID tagging would allow to more accurately track each piece of freight's location. So that's a couple industries I would recommend looking into. Let's go ahead and dive into specifics now I have 3 stocks that I've chosen, 2 primary, 1 depends heavily on a catalyst, and I'll go into that when we get there. Both these stocks that I've chosen to focus on are in that healthcare industry. I first have AbbVie Inc. AbbVie Inc. is a spinoff from Abbott Labs, pharmaceutical company. AbbVie is primarily responsible for the production of Humira, and that's where it's focused its profits from. It's its key drug, keystone, if you will. Now, if you're looking at the key ratios on my presentation right now, you'll notice some little hinky things going on. There is no debt to equity ratio, and there is no return on equity. The reason is AbbVie has just gone into a substantial amount of debt in order to purchase another pharmaceutical company by the name of Allergan or Allergan. Now, this is a fantastic move, as I believe it will widen AbbVie's economic moat and allow a little bit more diversity in its product line. New products coming out under AbbVie's names could lead to larger profits for the company, and Morningstar seems to agree with that, as it has its fair value at $101 per share when its current AbbVie's current stock price is about 87. This puts it at a 4-star value. Definitely worth looking into. The second healthcare stock is a big one. United Healthcare is a massive healthcare plan insurance company, and with that technological increases I talked about earlier, United seems to be implementing them. I've heard and read about AI diagnostic tools being implemented for United, and I do believe that they have the resources to properly and correctly implement all this new technological advances. Now, Morningstar again really seems to agree with me with a much higher fair value price at about 300. These key ratios are fantastic. The debt to equity ratio is much better than the industry average, and United just is a very large company, which seems to be playing in its favor for the next few years. Now, Walt Disney is a third stock I've put in. The reason I've mentioned this right now is the current price is higher than the fair value. It's overvalued for Morningstar. But the reason I really want to talk about this is there have been rumors of boycotts of some of the future Disney movies over some international concerns. Now, if this were to occur, I would expect that Walt Disney price would drop below that fair value, meaning you could scoop up some stock for cheaper prices than you would be able to now, and Walt Disney will go back on top for a short time. So it'll be interesting to see whether or not that actually occurs. Now, moving on to bond, the Federal Farm Credit Bank's bond is one that matures at 2034. Now, this is longer than that 10-year goal I had, but when looking at the yield and the coupon rate, this is one I believe would still be worth investing in, even beyond my original 10-year goal. Now, this bond isn't callable, and the coupon is fixed, meaning that it is susceptible to changes in interest and inflation as a whole. Oof. Now, this is a government bond, meaning that it is impacted heavily by our government, and I'm curious to see how the elections will affect inflation and interest, which affects this particular bond. The second bond I have is the Federal National Mortgage Association. This is another government bond, again, not callable. It is a fixed coupon rate of 6%, and it matures in 2028, which is within that 10-year period. Now, it has a lower yield than the Federal Farm Credit Banks. However, with a higher coupon rate, I do believe this is going to be worth looking into and worth investing in. and I would say I would split about 25% of that $100,000 across these two bonds. Now, moving into the two funds that I have picked out for this, I'm definitely looking at the Schwab and S&P 500 index. There's no minimum investment needed for this. It was impacted fairly heavily by the economic recession of 2008-2009. However, it has climbed and is now an extremely lucrative opportunity. A Sharpe ratio of just over average of 1.03, standard deviation 12.42. Now this fund is directly related to the S&P 500, so its composition is heavily in U.S. securities and is focusing mainly in the technology and financial services. The second fund I want to look into is the Baird Aggregate Bond Fund. This is an institutional class fund. Now this does have an investment minimum of $25,000. However, looking at 5-year average performance, there is an extremely high rate of return. However, the Sharpe ratio is below that 1.0 good rating that we want at 0.78. Standard deviation is 3.05. However, when you look at the low cost of this fund, it is definitely worth more research, if that's what you're willing to look into. It has a 93.97 fixed income composition. It is a bond fund. And it focuses mostly on the corporate, securitized, and government funds. It's not really looking at municipal bonds. Now, most of what I've looked at are long-term investments, meaning there's not a lot that you can really do beyond staying up to date with information on what's going on, whether or not that those movies will be boycotted for Disney, whether the technology is implemented correctly for United Healthcare over the next 1 to 3 years, is probably the best way to keep an eye on this. Take a look and definitely keep up to date with the political decisions over the next couple years and how that's going to impact the outlook over the next couple years, and whether that inflation rate is going to affect the bonds and the funds that I've put out here. Well, that about wraps it up, and I want to say thank you for your time. Have a good one.